Ladies and gentlemen, welcome to the Fintech Frenzy. Today, we have really three stories that I want to cover. One is about Robinhood, one's about SoFi, and one is about PayPal. All right. If I could, while everyone is filtering into the live stream, let me quickly bang off a couple stories before we get into the big topic, which is SoFi tonight. Okay. SoFi is going to be 85% of the conversation, which we're going to talk about their ability to be valued not just as a bank, but maybe something much more than that. Because I'm just watching all these different streams and watching these different people communicate about SoFi, and I just think they're missing all the picture because they're looking at the now and they're not looking at what the future could be, what I believe the future will be. Anyway, before we get into that, I want to cover a couple things. Now, first off, Hood Summit 2024. Holy crap. Isn't this fun? It would be so cool to see other stocks that we follow, like SoFi, for example, to do something just like this. I don't know why they don't have one like this directly for Galileo, for example. I mean, get all of their different companies together, offer, a pretty fun summit for people to get together. Anyway, this is going to kick off on October 16th with quite an exciting product reveal, these sort of things. So they're talking about, the next phase of Robinhood's growth. Can't wait to see what happens there. I'm pretty much on the same page as everyone else in terms of expectations. Desktop products, maybe index options, futures, something like this, maybe some AI products. It'll be interesting to see what they pull out. The very interesting part is that they said that this will be much larger than their gold event. I mean, you can already see that based on them having, a 3-day event versus just their regular couple-hour event, something like this. But still, very interesting. ETF says, hello. Jay says, good evening, everyone. Sagig says, hello. Richard says, hi. Unknown says W. Lisa's saying hi. She bought Airbus. Cool. But just one more quick story before we get into the SoFi portion of the show. I'll just quickly bang out some PayPal really quick. And that would be PayPal's Everywhere product. I'm not even really sure what it is. I've read through this thing like 2 times over. I still don't understand what they're releasing here. So introducing PayPal Everywhere. Essentially, what they're doing is exactly what PayPal already does. The only thing that I found that was new was this ability to auto reload your balances. Okay. Add the PayPal debit card to their mobile wallet, like Apple Wallet, for example. Cool. We already knew this. Large cashbacks in stores. That was already a thing. Stackable cashback rewards, already a thing. I guess it's the fact that maybe you can do this now in person as well. But the idea of signing up for PayPal really easily, getting a digital debit card, account numbers, everything like this has all been in place. But this was a large post by them. They showed this off. They showed Alex Chris made a big post about it. It was seemingly a big deal. Seems like business as usual to me. I mean, I was pricing this in already. Maybe I'm silly for doing so. The auto reload part is the only part that I think may be new to this list. Whatever. All right. Sounds good. All right. Let's move on. So let's talk some SoFi. People are done funneling in. I've given you guys 4 minutes. Let's get into the big story. Okay. I keep hearing people talk about SoFi as if their growth rates are not as exciting as they could be, and that there is going to be, no real valuation push because the tech platform is not doing what people think it's going to do. Okay. One, that's going to benefit greatly as rates are getting cut. More fintech funding means more potential clients for Galileo. More banking regulation means more clients for Galileo, as they are one of the very few players that are backed by a very large parent company, I should say. And other things like that are going to boost Galileo's platform. Okay. they're signing up top 5 banks. That's still in motion. I heard some conversations talking about that not being the case. Relax. Okay. That being said, what I also want to talk about is the idea of it being a bank is not enough for some investors. Talking about the growth rates are too slow or that the margins are not great enough, I call BS. Okay. Lending is an extremely profitable segment and it makes a ton of money at very, very high margins. Banks have some of the highest earnings across any of the sectors of the S&P 500. Financials have significantly outperformed the S&P for long, long periods of time. Not every single time. There's going to be times where information technology underperforms as well. But there's a reason why Berkshire Hathaway has made a fortune, and a large part of that has been in financials, has been in insurance, and all of these other things. So, SoFi is no different here. Now, SoFi has gone through some extremely large headwinds, and now we talk about the same ones over and over. But let me try to go at it at a little bit of a different step. So everyone talks about the student loan moratorium. I don't have to say everyone, it's me. Student loan moratorium, the home loan third-party loss, and then obviously the rate hikes that have taken away the personal loans. Or sorry, I shouldn't say taken away personal loans. Taken away the ability to sell loans is definitely more along the right track there. Now, We've covered that, the reason why it's very hard to sell loans, but the reason why it's so important for SoFi to sell loans rather than hold them, it's not all this mumbo jumbo about the idea that they can make more holding it than selling it and all this stuff. The reason why they would make more holding it than selling it is because the gain that they would make on selling it is really low right now. Okay, in an increasingly high rate environment, that makes it very hard to sell loans. Isn't it funny that as loans have sort of or as interest rates have begun to stabilize, they're beginning to resell loans and get higher capital ratios, even though it's more advantageous for them to hold them? No, that's just the way it works, okay? So they continue to sell more and more loans onto the marketplace. I wonder if I have a spreadsheet about this, or did I just... See, I've been messing around with my spreadsheets. For anyone that has access to my spreadsheets, you guys can go in. There are some changes made to the SoFi spreadsheet. You also have access to some of the other ones as well. But anyway, what's called? Let's just show something off for a real quick second. So looking at net income along with their adjustments made, I got to change this because I didn't realize that it's too small. Is that okay? Maybe a little bit lower. Awesome. Okay. I don't want any distractions, but at least you'll be able to see adjusted net revenue down here and then adjusted revenue growth year over year. Okay. And with this gets to show how SoFi before, back whenever they first became a public company, 74% year over year growth on the entire business. One quarter that significantly stuck out as bad, and then 54%, 49%, 50%, 51%, 58%, and then this is really where it happens. Q1 of 2023, 43, 37, 27%, 34, 26, 22. That depreciating amount. You can see that right here. All right. Maybe I can remove myself. There you go. Or I can throw myself over here for a sec. Although their revenue has been climbing very dramatically, that rate of growth has slowed over time. Okay. So the way people are pricing in their growth going forward is that, maybe we see 20% growth rates, maybe we see even lower because we're pricing in with that trajectory. Now, if we're looking at the high of 74% all the way down, it looks like this big trend line of just nothing but decreasing growth rates. But really, in this period of 2021 and 2022, it was actually pretty stagnant in terms of how fast SoFi was able to grow. That was back whenever they were actually able to sell loans. Then that completely fell apart here. And then this is where we see the collapse in their growth rates. Okay. And that also coincides with the Fed funds rate. explosively growing, historical high interest rate climbs over a small period of time. Not the highest rates, but the fastest, rate of change. Okay. But now we're in the other side of that period. Come September, we're going to see rate cuts, which means something very important. Okay. It means not only are we able to sell loans, but it's going to be advantageous for SoFi to sell loans versus holding them. That completely changes the game. Okay. That means that SoFi is going to free up a ton of capital. Their capital ratios are going to get much, much nicer, and then they can go out and re-sign loans with new clientele. Okay. Now, there's a couple, facets of that as well that we really have to get our heads around. One is there supply for new loans at SoFi's credit boxes. So can they actually, take on new loans and, keep them at good credit boxes right now? I've got an answer for that as well. I'm going to keep that. I've got a video I want to show you guys. But the answer essentially is yes, and we'll go through that in a second. But I just wanted to show off here. It is, in my opinion, that SoFi in this cutting rate environment is going to re-accelerate growth. Okay. I'll talk about what that means for the stock in a second. But if they're able to re-accelerate, get back into the 30s, maybe even 40% growth rates, it sounds ridiculous right now because we're not used to it in a very long time. If that is possible, what happens to the stock? Okay. Let's look at SoFi stock over the last little bit. Bear with me. The live stream is sponsored by Moomoo. You guys don't have to, go ahead and give them all your money just yet. But what I would suggest doing, what I think is a smart thing, just sign up and try their products. They're pretty sweet. All right. Since this company had become a public company, they actually opened up at a $10 price target. That quickly rose to $28 in February of 2021. 28 was the peak. And then right around January of 2023, we started seeing real bottoms of the stock at $4.24. Okay. Massive cutoff from the stock. And now we're staying stagnant in the $7, $8 mark. No movement. All right. Let's show you why that's important. I'm going to go to analyst predictions and EPS revisions for the company. You can see here, these are the highest points for which SoFi had the highest price targets on the company. January of 2022, okay, were the highest prices in the stock, and the lowest were, where is it? Should be, I'm trying to look on my thing here. Anyway, you could say it's maybe about here, maybe about, yeah, actually probably here. If we're looking at the orange line, probably about here in terms of their lowest, which is also January of 2023. Okay. Back whenever they thought that there was still going to be losses by December of 2024. Now we know that that's obviously not going to be the case. This is the same stock that we're talking about. One, they thought that 2024 was not going to be profitable at all, -1 cent of EPS. Now they're looking at 9 cents. By the time we finish out, it'll probably be somewhere around 11 to 13. It'll be a very different story as the time still progresses. All right, let's go back. Okay. At the very low, once again, January of 2023, this stock is trading based on how much earnings they are essentially going to get. Now, there's a whole macro tide behind that, and everything that has to do with the interest rates that SoFi is playing in, and the different products that they're able to benefit versus decrease. But overall, the story that is being told is, if analysts think that growth is going to be high, the stock can end up getting priced better. If it isn't, that means the stock is going to end up getting priced worse. Okay? You can see this exact same story get played out in a couple of different stocks. One, Robinhood. Robinhood, same thing. Whenever expectations for EPS growth over time were really low, the stock was just getting crushed. As it improved, the stock exploded. Another one, Palantir. The stock, where is it? Sorry. The stock at its absolute highest was over in this area right here where EPS growth was expected to be explosive. Its absolute lowest in the stock was over here. Okay. And let me just show you that just so then you don't have to trust my word for it. It lines up all the exact same. Right at the start, EPS growth explosive into the highest peaks. And then at the very, very lows, December and January, maybe February, absolute lows of Palantir, same area. Robinhood, no different. All right. Lines up exactly with Palantir's EPS revisions, right? January, February of 2023. Now, this is regular. Like, I'm not saying I'm finding anything that's cracking any codes here. That makes 100% sense. Okay. Companies are priced based on what they are expected to bring in as a multiple, they are being priced at a multiple of how much they're expected to bring in of future growth. Everyone say hi to Lincoln, but he's distracting me while I have to work here. So, see, he's distracting me. Essentially, the faster growth rate, the more price that a company is going to get priced in. Now, here's the thing. If rates are going to be cut, then, well, I've already said this, but the capital ratios will be able to get freed up. That is SoFi's large concern. I want to talk to you or show you guys a video. Hopefully you guys have already seen it. But this is my conversation with Dan Dolev. I asked him if there's going to be enough personal loan supply available if SoFi or if, rates start to cut. Is that part of their business ever going to dry up? Let's take a listen to that really quick.
I can't predict demand for personal loans. I think from everything we've seen, and we cover Upstart, we cover Firm, we cover obviously SoFi, so we cover at least three, and Square, which does buy now pay later, but it's small. So I've never seen shortage, and this goes back to some of my conversations with Sanjay from Upstart. I've never seen shortage of demand for credit. What I've seen is shortage of supply.
No shortage of demand, only shortage of supply. Okay? So if you take that, you start thinking about SoFi. Did we have a shortage of supply? Yes, because they got regulatorily blocked from giving out more personal loans. They had to manufacture a slowdown in their ability to hand out new loans because they didn't have enough capital to end up leveraging themselves more and more and more to give out new personal loans. So growth continues to slow. Okay. Now that they're able to sell, he is still here, by the way. He jumped right back up. I'm just keeping him on my lap so I can keep him calm. If he, I'm this cat, man. If there's ability to get essentially loans off the balance sheet, get more cash, then they can end up, giving out more loans because there's no shortage of demand, as Dan Dolev says. Okay. The interesting part here is that ability for SoFi to re-accelerate to a 30% growth rate, 40% growth rate if we see a really good year-over-year comparison. It's happening on Robinhood side, and it feels impossible right now on SoFi side. But the idea that everything is tied to SoFi's valuation on just Galileo is something that I can't say. Why can't I like this really fast-growing bank? Why can't I like the fact that they are going into an environment that after multiple years has been the largest headwind, and now they've grown, they've 4x'd their member count, and now we're on the other side of those headwinds. Now we're on tailwind side with a much larger total bank, and everyone's looking at the bank as if it's a big problem. Oh, the reason why SoFi got killed is because now they have more tools in their tool belt. Bull crap, dude. I'm sick of that sort of argument. They are much stronger. They're much more flexible now. The only problems were those regulatory minimums, which would still happen if they were a fintech or a bank. Okay, their ability to sell loans would still have been hampered. You can look at any of the lending fintechs, they would have gotten destroyed during that period. Tanner, what if job losses accelerate and unemployment rate ticks up to 5+%? I mean, then I would hope that the Fed ends up doing some more drastic measures to end up trying to help businesses rather than keep interest rates extremely high. The part that's really going to crumble is the subprime area. Even prime can end up facing some severe penalties, and SoFi is going to be in that sort of area as well. I mean, they're not recession proof, but being on the other side of prime, the prime plus and the super prime area is a extreme buffer from any sort of recession fears or something like that. It really does pay for these members that are getting paid hundreds of thousands of plus incomes. Are they all going to every job that ends up getting lost going to be SoFi members? Heck no. Wait till there's super duper prime. Yeah, but super duper prime is what's it called? A SoFi member. Yeah, the thing is with companies like Affirm and Upstart seeing all these benefits to their stock based on their ability to sell loans, but SoFi is not going to see those benefits, I think is crazy. They will be able to sell loans and they'll be able to refuel that growth, whether that's student loans, home loans, or personal loans. They have many more tools. It's a crazy argument. I think the biggest problem for SoFi was their capital ratio constraints. Like, they just had a true problem growing. Like, they were running into a wall. Now, with interest, like, what we don't want is a gap down in interest rates. That can be a big problem. Multiple cuts along the way is what is really going to benefit SoFi, as they can keep their coupon rates high on their loans, and the ability to sell loans will be more advantageous for them to do that than to hold on loans. And then they can recycle their book multiple times in a year. That's when SoFi was getting $20+ a share. Okay. It wasn't based on it was based on a frothy market, but that frothy market had means. Okay. The means were that SoFi was growing at a 70+% growth rate. Now at 22%, a company that grows at a 70% rate over 3 years versus a company that's growing at 20, or what people might believe is slowing down into a 15% growth rate, which is what Wall Street is end up anticipating, is a slowdown of growth into the teens, I think goes away whenever they actually start to see how SoFi fundamentally does. I love Noto, but I think he's playing everything too safe. Not true at all. Not true at all. They're speaking out one side, and he's not talking up his book. But the truth is like, they're talking about how lending is going to slow 5% versus last year. One, it's accelerated in the first 6 months of this year. It's already doing better than 2023. They're expecting a slowdown. They're not even on par. They're doing better. Okay. And what was I going to say? And this quarter, they just gave out another $5.3 billion of originations. Like, they are not playing it safe. They're talking safe, but that doesn't mean that they're playing it too safe. Look at Lending Club. That's what safe looks like. I would have preferred he re-accelerated lending volumes in Q1 only to discover that macro would have fallen off a cliff. I mean, he did, like, they did re-accelerate. There's two sides of it, right? Look at their originations. Look at what they're actually doing. I don't know. Am I crazy? SoFi is getting a quote unquote bank valuation because we're at the peakiest of peaks right now in terms of slowdown, I guess you could say. But all this talk of SoFi's inability to re-accelerate, and the only thing that's holding up this story is Galileo, is dog shit. Galileo's cool. It's never been my bull case. If you want Galileo, there's a pure Galileo play. You can go buy Marqeta. The cool part is that it's a consumer-facing bank that has its own tech platform built into it that they can leverage. That is also making money. It's like if Lending Club, not Lending Club, Nubank. I love Nubank. But if Nubank also had a segment of their business where they were selling to Mercado Libre and C4 and all these different companies, if they were selling them, their own tech stack and saying, hey, you guys can also have this, it's just an added benefit. It doesn't, make or break Nubank. Nubank is Nubank. Then he completely failed to relay the message to market and analysts. Everyone thinks that SoFi is hiding in a hole with recession fear, I think is what you're trying to say. I mean, that can be true. I don't think that they're the best communicator of their market position right now, but Anthony Noto's a smart guy. I don't know if there's, he's talking off his books, so then they don't get I've got no clue. But I prefer what they're actually doing fundamentally. And in a bull market, let's see how he actually does. I want to see if for Anthony Noto to get paid in 2026, the stock's got to hit $25, $35, $45, somewhere around there for him to actually truly financially benefit from SoFi's success in a great way. Okay. As that starts to tick closer and we get closer to there, then let's start to see how he talks. I mean, yes, we've been in a bull market. What has not been, I shouldn't have said bull market. I should have said a falling rate environment or a tailwind environment, let's say. One that benefits SoFi's growth. The problem is Robinhood is actually seeing real acceleration to their business. Palantir, real acceleration. Affirm, real acceleration. SoFi, we're going to need to see it. Now, like I said, their EPS for, from the beginning of the year was expected to be negative. Now it's 9 cents from Wall Street. I think it'll go even higher than that. No, I don't think I've ever disclosed my percentage of my portfolio that's SoFi Holdings. No. I don't think I have. All I'm buying B-Dub says all he's buying right now is dividend stocks. I have a portfolio of 10 of them. But that, I think you're also potentially, I mean, I don't know. In a recession, that'll do fine. But it's also like you're sort of chasing the dragon on what has worked, essentially. I'm still in the camp that Q3 is going to be a really strong quarter. And now I feel like the whole market has turned to this idea that recession is going to be the next most obvious play here, but I don't know. Nvidia has a great yield on its dividend. Yeah, no, definitely. Big dividend play, Nvidia is. No, I get that, B-dubs. I got where you were coming from. I feel like everyone's sort of pointing that direction already, which also gives me fears that potentially that's not going to be the play. Selling covered calls on DGT. I look at that stock like it's a donation bucket. I'd never ever play it. If you believe in the guy, sure, you can give him your money, but just, don't expect it to not be diluted. Jeff Hines says his position in SoFi is 99% of his portfolio. Jeez. All right, ladies and gentlemen, thank you all so much for watching. I think that the valuation on SoFi is going to be dependent on their ability to reaccelerate growth. I think that can happen. I don't think a lot has to go right for that to happen. I think that they just need to get to a ability where they're able to sell loans at a greater gain on sale margin than there would be more beneficial for them to hold it versus, go out and try to originate another loan. On top of that, we have a growing segment in SoFi Invest, SoFi Money, SoFi Relay, credit cards, and then every lending product. And hopefully we continue to land new Galileo products. The idea that SoFi is in somehow a weaker position today than they were whenever they were $20 is baloney. Thank you so much for watching. Really do appreciate your time. And bye for now.